Good morning, everyone. Thank you for joining us this morning for our Phillip Research Morning Call. So today on the agenda, we have a few stock counter updates, including Netflix, Capitaland Investment Limited, Fortress Mineral, Aztech Global, and RENS. And we'll wrap things up with a Phillip Singapore Weekly. Without further ado, I'll now pass the time on to Jonathan, who will talk to us about Netflix.
Thanks, Nat, and good morning, everyone. Okay, so this morning I'll be sharing on Netflix, which with the title of Scaling to Higher Margins and Cash Flow. So we actually are initiating coverage on Netflix with an accumulate rating and a target price of $724 US. So just a little brief background into Netflix. They're a provider of on-demand commercial-free internet streaming services. So currently they have about 209 million paid memberships in more than 190 countries across the world. Their revenue is primarily from monthly subscription fees, which range from $2 US to $24 US per month. 36% of the total users come from US and Canada, 33% come from Europe, Middle East, and Africa, 18% come from Latin America, and the remaining 13% from Asia Pacific. So in terms of the industry, the main Netflix's main competitors are Hulu, HBO Max, Disney Plus, and Amazon Prime. But we kind of discount Amazon Prime numbers a little bit because of the way their subscription is based, given that Amazon Prime membership is mainly for e-commerce and not really for video. Just to put into some context, in terms of content quality, Netflix original series and specials received 129 Emmy nominations this year. Moving on to the revenue model. So like I said previously, their main revenue stream comes from streaming, but they do also have a small DVD rental business that they actually started out with, and that's really only domestically in the US. So in terms of revenue geography, 46% of revenue comes from UCAN, 31% from EMEA, 13% from Latin America, and 10% from APAC. So for FY20, revenue came in at 25 billion, which was a 24% year-on-year increase. PATMI was 2.8 billion, a 48% increase. Net margins came in at 11%, and their average monthly revenue per membership, or ARM, was $10.91. So the ARM is actually the total revenue for a given period divided by the average number of paid memberships. So you can actually look at it as pricing. So if you've got three investment theses, the first would be we see a continuing trend of positive net paid additions. So Netflix actually ended last year with 204 million memberships, or a 22% year-on-year increase. And memberships have been actually increasing at a 23% for your CAGR, which is roughly, if you take it as a linear track, it's 27 million heads per year. So if we can see in the top right chart over here, this is just the relationship between revenue and paid membership. So it's quite obvious when you look at it, the more members they have, the larger the revenue. This red dotted line here it shows the linear trend. I'm not sure how clear it is, but you can see that for FY20, there was a little jump in terms of paid memberships, largely due to COVID lockdowns. No one was really able to go out. They just spend their time searching for other entertainment options. And we do expect this to dip slightly so that it falls back on their linear growth rate for the next couple of years. As mentioned earlier in the previous slide, so the ARM was $10.91, which is largely flat from FY19. But we do expect a significant increase in this just based on price hikes in the UCAN and EMEA regions towards the end of last year. So they weren't really fully accounted for last year, but we'll definitely see it this year. And due to the increases in volume and price, we do also expect revenue to increase 18% for FY21. So for our second thesis, we're very bullish about the expanding net margins and positive free cash flow for the first time. So net margins for FY20 was 11%, which is about 5 times more than it was when it was in FY16. So it grew from 2% to 11% in 4 or 5 years. We do expect these margins to increase moving forward as well, just based on their efficiency in scaling their business, which you can see in the top right chart over here. So the expanding margins are also due to the fixed cost structure for Netflix, where most of their costs actually come from content spend, and it's incurred upfront regardless of the number of members they have. So once this cost is covered by the number of members, each additional member that they get, or each additional subscription that they get is just exponential profit growth. We also see that in the bottom right chart, it gives you the per user data of revenue and content costs. So the red line is actually the ARM, which is your pricing. And the blue line right here, which is pretty flat, is your total content cost divided by the number of users. You can see that the content cost remains relatively flat while your ARM is growing exponentially. And this kind of fortifies your net margin growth because you see the gap here getting bigger. So we're also quite positive on Netflix because of they reported free cash flow for the first time ever, which we see as a significant milestone. And this is mainly generated from positive cash from their ops, which is the first time ever that they've generated positive cash from operations. We also like it because it's able Netflix to be able to self-fund their growth without relying too much on debt. And for investors, it's good because there's always this potential for share buybacks, which they have actually done earlier this year already. It adds values to investors because it boosts your EPS and share price. So moving on to our final thesis, we're actually very bullish as well on the enormous potential for growth, because Netflix is actually only 20% penetrated in households globally, excluding China. And so we also see this as a substantial runway for growth, like you see in this chart on the right, which is the worldwide streaming market. You can see that it's continuing to increase year on year, which should provide tailwinds for Netflix moving forward. We're also very bullish on shifts in consumer behavior. Nowadays less and less people want to watch linear TV. More people want to watch whatever they want, whenever they want. They want the flexible options, like Netflix, like Hulu, and so on. And so we definitely see this trend continuing moving forward, which should provide tailwinds for Netflix's customer acquisition. We also see a robust global mobile broadband market, which is actually good for Netflix because they actually have a cheaper mobile-only plans that they've actually launched in quite a number of emerging markets. And the main reason for this is to target potential users that don't have broadband at home. And there's actually quite a strong potential for this because of the larger population density in these emerging markets. So finally, Netflix is actually attempting to expand their content experiences by moving into gaming, just to complement their existing streaming services. And this is kind of a strategy that they really want because it provides a bit more of an in-depth experience, entertainment experience for users. So for example, if a series kind of ends, after X number of seasons, they can kind of continue on this storyline through gaming to kind of enhance the experience for, especially in a lot of the Asian like manga, comics, and stuff like that. So this is generally the direction that they're moving into. So in terms of risks, we see a couple of risks. The first would be near-term risks on tougher comps for this year compared to last year. Like I mentioned earlier, there was an increased level of paid memberships in FY20 due to lockdowns. But we do expect a short-term growth slowdown, which hopefully shouldn't last too long. And we hope that Netflix will be able to revert back to a more linear growth trajectory moving forward. Second risk would be foreign regulations governing content in different countries. So because Netflix is in a whole bunch of different countries, there are a lot of regulations or restrictions imposed by local governments. Some of these restrictions include like content allocation and restrictions. So some of them mandate that there must be an X percentage of shows within Netflix's library that has to be locally produced, which could kind of provide a stumbling block for Netflix if they are trying to expand foreign content in different countries. There are also different censorship regulations in different countries, which could potentially hinder growth opportunities as well. So for our valuation, we initiate coverage with an accumulate rating and a price target of $724. Our valuation is based on a DCF valuation using a 9% WACC and 3% terminal growth rate. So that's all for Netflix. I'll pass my time back to Natalie. Thank you.
Thank you, Jonathan. Okay, I'll now talk about our Capitaland investment. Okay, so first of all, before we get started, most of you may be familiar with Capitaland. I just want to briefly talk about how their segmental breakdown will look like now post-merger. CLI actually breaks down their revenue into two different categories. First of all, the fee income business segments, which comprises of your investment and asset management, property management, as well as the lodging management. So this segment is largely AUM driven. Okay, so for investment management, it's the segment that actually manages the listed REITs as well as the unlisted platforms, and it's driven by fund assets under management. Similarly, for portfolio management, it is driven by the amount of assets under management. Lodging management is driven by the number of keys under management. Okay, and for the investment and asset management, this is largely recurring. 80% of the fees are recurring based on AUM. Of course, there's a small portion which is driven by transaction costs, your acquisition and divestment fees, and also, of course, the promote and performance fees. For fund management, for property management, of course, that what you get from this segment is property management fees, and for lodging management, you are earning the franchising management fees as well as a percentage of turnover. Okay. The next segment would be the real estate investment segment, which comprises the investment property held directly by Capitaland or through its associates and joint ventures, stakes in listed funds as well as stakes in unlisted funds. So this segment is driven by, the driver would be the performance of the underlying asset, which of course is enhanced by value-add activities such as AEIs, asset enhancement initiatives, developments, redevelopments, as well as capital recycling, whether or not they can divest their assets at above book. In terms of revenue, this segment will contribute rental income, DPU, and share of profits respectively. Okay, so now I'll move on to the investment merits. Okay. For the first investment merit, we think that we will see stable and recurring revenues from the fee income as well as the real estate investments. So without the bulky and lumpy development portfolio, the incomes are expected to be more visible and highly recurring. Okay. In terms of revenue and EBITDA breakdown, you can see the graph on the right-hand side that the fees under management actually contributes 35% and 17% to revenue and EBITDA respectively, while the bulk of it actually comes from the real estate investment, 64 or rather 65% of revenue and 83% of revenue respectively. Okay, so Capitaland is still relatively asset heavy at this point. Okay, yeah. So earlier I mentioned the respective kind of recurring income from the IAM. 80% of fees are recurring. For lodging management, 80% of the keys under management are actually third-party owned. So this means that the lodging platform is relatively asset-light. And yeah, we also expect highly visible rental income from the real estate investments. Next, our second thesis would be the growth in fund management and lodging happy with where they are currently in terms of fund under management and the number of keys under management. They still hope to grow this number, and there's still unrealized potential. So for the investment and asset management side, as you can see, the amount of funds under management has been growing at a 5-year CAGR of about 11% per annum. And currently they are still about $17 billion short of their 2024 target of 100 billion AUM. So so this 11% 5-year CAGR has been largely attributed to the growth in listed funds, as well as the acquisition of Ascender Singbridge in FY19, which we saw this bump in the amount of funds under management. So moving forward, CLI hopes to capture private capital demand for real estate products via its private funds, and they have brought on 2 new senior hires to spearhead this growth in private funds. On the lodging side, they have a 2023 target of 160,000 keys. Currently, they are at 128,000 or 129,000 keys. And 40% of these keys, as denoted by the red shaded areas of the graph on the right-hand side, they are still under development. That means that they have not begun contributing revenue yet. So there is a bit of unrealized potential in the current fees income. Yeah. Okay. And just to provide some color, FY20 was a pandemic year and not a very good year for hospitality in general. However, FY20 was the year where they signed a record number of keys. They beat their 2019 number of keys signed, and it was 14,200 keys. Currently, 8 months into 2021, they have actually already surpassed the number of keys that was signed in 2020 for the same period of time, for the same 8 months period. So all in, everything points to CLI being able to meet or even surpass their target, their FY 2023 target of 160,000 keys. Next, moving on to the third thesis, which is the 3 billion divestment targets that Capitaland Investment has reiterated, and with the proceeds being channeled into new economy sectors. Okay. So far, as of 6 months, 2021, Capitaland Investment has already met its, or rather surpassed its $3 billion divestment target. And traditionally, Capitaland started off as a mall operator, office operator, and right now it's trying to, pivot, rebalance into new economy sectors such as the logistics, data centers, business parks, as well as some long-stay lodging assets like your purpose-built student accommodation and your multi-family assets. So these, as Capitaland divests and hopefully to some of their own REITs or their private funds, which will then channel growth in fund AUM as well as fee income, then Capitaland will hope to acquire some of these new economy sector assets. And this, of course, will provide some help to keep their portfolio future ready. In terms of outlook, we expect the portfolio to continue to recover on the back of reopening and return to normalcy. And the growth in investment management and lodging platforms, we expect that to continue growing and contributing more meaningfully. Of course, we also can look forward to the monetization of the balance sheet and rebalancing into new economy assets. We initiate on Capitaland Investment with an accumulate rating and a sum of the parts valuation of $4. On the right hand side, you see the breakdown of valuation, just to give you some color of how the valuation was derived. So earlier I mentioned that Capitaland is still relatively asset heavy. Bulk of the valuation actually comes from the listed REITs, 44%, IP 37%, and the unlisted funds, which contribute about 30% of the valuation. A smaller contribution coming from the investment management platform as well as the lodging management platform at 17 and 5.5%. Okay, so at this current price, the target price represents a 19.6% upside from our current price, and at this price, Capitaland is trading at 16 times PE ratio, and we are forecasting an FY21 dividend yield of about 2.4%. So that's all from me. I'll now pass the time on to Vivian for Fortress Mineral.
Thank you, Natalie. So for Fortress Minerals 2Q22 results update, this quarter they were hit by the production disruptions. So in the next slide, first of all, if you take a look at the table on your left, you can see that the first positive point is that they achieved higher average realized price, or ASPs, of about $142 per dry metric ton, and this is about a 48% increase. The second positive point is that the operating cash flow and free cash flow both increased to 6.3 million and 2.2 million respectively for 2Q22. Moving on to the negatives, the sales volume was impacted by the production disruptions at Bukit Besi mine. So you can see from the table that the sales volume fell by about 49%. And this was affected due to the FMCO, or Full Movement Control Order, for a period of about 5 weeks. So during this period, they were only allowed to keep operations in a warm idle condition and at 10% operating capacity. So what this means is basically they had to keep the machines running, because you cannot just switch all the machines off and resume production maybe 1 or 2 weeks later and expect the efficiency to be at the same level. So in line with the lower sales volume, they also incurred higher average unit costs. The bank borrowings increased to 23 million, and they now have a net debt of around 14.7 million. And this is mainly for the acquisition of Fortress Mangapur and also other plant equipment. So in the next slide, if you take a look at the outlook, so iron ore prices are expected to remain weaker at about $140 per dry metric ton. If you refer to the graph on your top left, this is the iron ore prices for 65% Fe CFR North China, CFR meaning the cost and freight terms. So you can see that at current levels of around 150, it has fallen about 50% from the peak levels in May 2021. And iron ore prices are expected to remain weaker because the reason why we say weaker is that at current levels of 150, it is still considered an increase year on year if you compare to the October 2020 or August 2020 levels, where it was trending at about 130 to 140. So that's it. We expect the prices to remain around 140. And another factor that could be causing this would be the continuous fall in the steel production for China. So if you refer to the graph on your bottom left, you can see that the absolute value of the steel production produced has been falling since June. But year to date, August 2021, there is still a 5.5% increase on a year-on-year basis. But the Chinese government has ordered for steel mills to keep 2021 production levels on par with 2020. So we are expecting further production cuts for the rest of the year. Another factor that is actually helping this would be the tightening regulations on the property market, including the higher mortgage rates and also stricter measures on property developers. The property market in China alone makes up about 20% of the world's steel demand. So with that, this could also contribute to lower steel demand in the near future. We downgrade to accumulate with a lower target price of 51 cents from 81 cents as we incorporate weaker iron ore prices. FY22 PATMI is lowered by 22% to $24 million. Our forecasted FY22 sales volume is also lowered by about 9%, as we expect the sales volume to be on par with FY21 levels. So that's all for Fortress Minerals. I will now be moving on to Phillip on the ground for Aztech Global's 3Q21 business updates. We do not have coverage on Aztech, so this is just a summary of the update. So firstly, on the key highlights, 3Q21 revenue was up 6%, and net profit increased 3% to $18 million. Similar to previous quarters, the revenue increase was driven by higher production volume and shipment of IoT devices and data communication products. During the MCO, which affected productions at the Johor plant, some production orders were transferred to the China facilities, which still account for the bulk of their production orders at about 80%. The order book remains strong at about 636 million, if you refer to the green bar in the middle, and this is inclusive of 210 million to be delivered for 4Q21. So they have secured $426 million worth of orders for completion in FY22 so far. Based on the 210 forecasted for 4Q21, and we have also done a chart on the top right to show the quarterly trend in the revenue. So far for FY21, the revenue increased from 116 million in first Q to 141 million in 3Q, and projecting 210 for 4Q. So you can see that on a quarterly basis, the increase is there, but the year-on-year change has been declining. And with 210, it's actually a 5% decrease year-on-year for 4Q. So other than the lower base in first half 2020, they are also restricted by the tight global components situation, which is expected to continue in the next 6 to 12 months. A bit more color on this. So as reported in the news, Apple has cut iPhone production goals as semiconductor suppliers like Broadcom and Texas Instruments are struggling to deliver. However, Aztech has still done well, considering that they have managed to deliver a majority of the customer orders on schedule, despite the workforce limitations and the global components shortage. On the valuation side, according to Bloomberg consensus estimates for FY21, they are currently trading at about 10.5 times PE, which is lower than comparing to peers like AEM or UMS, which are trading at around 14-15 times. Lastly, on the production side, other updates include they have been continuously ramping up the vaccination rates at the Malaysia plant. So 85% of the employees are fully vaccinated. So they are expecting to operate at full capacity starting this week. On the China side, there is also limited impact from the power usage regulations because the situation is such that they are charged less for electricity usage during non-peak hours. So a very simple example would be to continue the production during the holidays. So that's how they have been dealing with the situation. So that's all for Aztech. I'll now be passing the time on to Paul for Singapore Weekly.
Yeah, thanks. Let me just take control of the. Okay, move on to the next slide. Okay. Sorry for this because it's a bit sensitive. Yeah. Okay. In terms of some of the macro news that came out for Singapore, the first one will be RMC, which is a ready-mix concrete. We use this just to track Pan United because Pan United is the largest ready-mix concrete supplier in Singapore. So if you look at the volumes in August, it's doubled to 949. But when we compare it to pre-pandemic, it's still down about 13%, but it's still a very strong rebound because third quarter so far, which is July and August, is already, I guess, up more than threefold. But again, the prior year's volumes were exceptionally low. But key for us is at least the trajectory of the rebound remains healthy. The second point, which is property volumes. So we already released the numbers, about 834 units. It's down year on year. And it's down from the August of the prior month. But when you take it as a whole, the whole of third quarter is about 3,006. So it's virtually flat compared to a year ago. The other piece of news that came out was the MAS monetary policy statement. I don't really doubt it really affects the stock market, but for what it's worth, we're just going to go a bit more detail on this. So they've changed the policy stance. So just to give you a refresh, in terms of the MAS monetary policy, they either move the slope of the exchange rate, they widen the band, because it's always in a band, or they take the most aggressive, they gap it up or gap it down, depending on economic conditions. So it was zero appreciation when the pandemic hit. No, zero because they do not want to tighten monetary policy, which is to raise the slope or to strengthen the currency. But now that we are in stronger footing because we are above trend in growth rate and also the CPI is also higher than expected, I think they've raised slightly the slope in the current monetary policy. We'll have a slide later on for this. In terms of US, the numbers are still very strong. Consumer spending or retail sales is very robust in the US. So it's up about 15 or almost 16% year on year. Now, I think China is only like 3 to 4%. and although it's a deceleration, but 15% is still very strong because pre-pandemic, the retail sales in the US was trending 3 to 4%. So right now, it's running maybe 5 times higher than the typical 3 to 4 times. Although there is some base effect here, but once you hit August, September, you get less and less of this base effect. The other positive news is the job openings or in the basically available jobs in the US is a record high of 10.4 million. Although it's off the prior month, but 10.4 is still at record levels. And basically, in August, the amount of jobs added in the US was 366,000. But there are 10 million jobs. So you can see the ratio here. That's why there's so many vacancies and unfilled jobs, especially in the service sector in the US. We'll discuss later RE&S because they are a Japanese F&B operator, but just to get a sense of what's happening there. Technically, the market is bullish because we are getting a major re-rating of Singapore equities following the aggressive reopening of the VTL lanes, and also globally, more and more countries are starting to open up. When we reopen borders across the board, almost every sector will benefit and enjoy because it will just make our domestic economy rebound stronger. Now, in terms of the weeks ahead, so today it's probably an important piece of news is maybe on the SGX because in Hong Kong they are releasing the MSCI Connect A50. This is important because SGX A50 contract is almost 30 to 40% of the derivatives volume. So if this thing takes off, then obviously it's going to hurt SGX. But again, it's still early. I think it just launched today. These are the other pieces of news. In terms of our webinar, so we have a First Ship Trust tomorrow and then OZ Group, I think on Thursday, for those who are interested this week. And of course, we have the SPH, which will discuss about the capital offer. Okay, move on to the next slide. In terms of the global COVID cases, the good news is trending lower. It's still declining almost 30% month on month. And these are some of the news, the reopening news of Bali, Fiji. I think you can see it all over the news. I think the more important one is the US. The US is also starting to reopen to vaccinated travelers. Nothing much here. This is our Singapore COVID-19 cases. It's starting to flatten. I mean, hopefully this is a trend. I guess the bigger news is that ICU is probably a big jump from a week ago. Okay, this is just some illustration of some of the data points. So you can see this is the RMC ready mix. So all these are very difficult to compare because these are, so right now, you get the double because it's 981 compared to 400. But for us, more important is that you're getting this big, strong, sharp recovery for ready mix concrete. And hopefully it can return back to the pre-pandemic levels of about 1 million cubic meters a month. The other thing is just another data point we got was Singapore taxi fleet. So just to refresh, you can see Singapore taxi fleet was already trending lower. But when the pandemic hit, you get this big gap down from, I don't know, 18,000. This is the industry, not confirmed. Industry, then you get down to 16,000+. Right now, hopefully it's stabilizing. So just to refresh, I mean, we still have a buy on Comfort. We still like the stock. Again, we are, like we mentioned before, no illusions. We know there are structural challenges, but again, this stock was pre-pandemic was 230 something, now it's 150. So our target about 180+. So we're just buying on the rebound and also the restructuring of downtown line. If you just go on these two charts are just property, so you can see that quarter and quarter is flat. So in terms of the real estate agent, if I were to translate it to real estate agent news, so what it may mean is that the existing home sales, which is the resale homes, probably volumes are still strong, but again, new homes is probably the growth rate is probably going to slow down as we move forward. In terms of on a year-on-year basis, so this is the yearly sales of property, new residential, excluding EC. So I guess the only message here is that you can see that the property market is extremely vibrant. This is up to September. So there's a high chance we could exceed the 2017, the last time they relaxed property. So 3 more months, so maybe we could hit, I don't know, 12,000 plus. So this could be the best year since 2018 when they introduced the TDS. Okay, this is a bit complicated. It's not going to change our view on the SGX, on the STI or Singapore market, but again, this is, since there's so much publicity over this. So anyway, this is the nominal. So this is the exchange rate. This is the Singapore trade weighted exchange rate. No? And this is the US dollar in rate. So what we're just trying to show you is that the green bar is, during the global crisis, that's when they recentered downwards. Recentered downwards, they want to weaken the Singapore exchange rate. So you can see this big gap down here. It's a bit hard to see because it looks like, but actually they gapped it down here because the economy was weakening. But ever since then, they will probably have zero appreciation, or they recenter outwards because the global economy was stronger than expected. So they make the Singapore dollar stronger, make Singapore stronger. But most times, the MAS monetary policy is to increase slightly. That means a gradual appreciation of the exchange rate. You can see there's some influence on the US dollar when we were rising, but from this point onwards, it's a bit harder to see the trend in terms of the impact on the US dollar. So when COVID happened, so we had this zero appreciation when COVID occurred. So you can see this, I guess this gap down here. Then after we just went sideways because we had this flattening of the curve, of the exchange rate. So right now we're going to go back on this slightly upwards. And in general, when we do this increase slightly, the currency appreciates probably 1.7, 1.8% per annum. I mean, just a general view. So there's an incremental rise per annum against the basket of goods. And this is the core inflation. This is very academic, but what we're just trying to say is that in 2021, the MAS monetary policy was for CPI, what they thought the inflation will be was from 0 to 1. So right now you can see that it's above 1. So what it means is that, and now they're guiding that the inflation rate in Singapore will probably hit 1 to 2%, probably hit around 2. So we're just trying to say that I don't think MAS thinks the inflation is transient, it's short term. So even 2022, they think inflation will continue to rise. Again, this is just for academic purpose if anybody wants to know. Okay, back to the US, we just want to show the strong growth rate. Retail sales used to be around 4-5%, now it's about 15%. And this is not just because of the base. You can see the beige line here, the 12 months. So what it just shows that we are experiencing record, since the fiscal stimulus, you can see this big jump here in retail sales. So we are enjoying this huge record retail sales in the US. So I mean, if anyone argues about stagflation, then it's a bit hard when you can see that aggregate demand is so strong. The other piece of news supporting the US economy, of course, jobs. This is the red line is the openings. So you can see that this is even better than 2006, the amount of job openings. And they only added 366. That means there's still like 10 million jobs unfilled. Okay, we just want to run through a bit on SIA, but this is the US airline traffic. We all know the meaning of revenge travel, but just to give you an illustration, you can see in the US, travel is rebounding very sharply. It's like 200% up in terms of 74 million passengers. And it's only just 15% below pre-pandemic. So when borders open, I mean, without stating the obvious, you will get this huge spike up, like 200-300% jump in passengers like you see in the US. Okay, we got a lot of questions on SIA. So let me just explain a little bit why we think it's a play on momentum, obviously, but maybe not on the fundamentals. So if you look at this chart, so this is market cap. So Singapore SIA's market cap pre-pandemic, that means 31st December, was about 11 billion. So right now the market cap is 16 billion. So in a way, you can say they've really kind of priced in a lot of this recovery. If you want to talk about valuations, it's 0.9 times book. Right now it's 0.7, but there is a quote here because it's how you want to determine the mandatory convertible bonds. So if you take into account the bonds, the price to book now is 1.64. You can see that it's like record high levels. And just to refresh everyone, purely academic, if you want, I mean, some may or may not understand, but Right now, this is the number of shares on SIA, the 2.9 billion shares. But you can see once this convertible bonds are converted into shares, is a big jump from 3 billion. The number of shares will double. But all this is not in the book value right now because they're assuming it's not converted. But I mean, there's a high chance SIA will convert because if they don't convert, then SIA has to pay almost 10 billion or 9.5 billion of the bonds. And if they wait until 2030 to convert, to pay back, it's going to be almost 17 billion. They have to pay back the convertible bonds because all these MCBs, some of you might have it. There's actually interest imputed in it, like 4%, then 5%, and 6%. Again, I'm probably confusing everyone, but let me just continue. So the thing about MCB, mandatory convertible bond, is that all this 9.5 billion that you see actually is part of the book value, but not the shares. So that's the most amazing thing about the MCB is like the heavenly. We always call it the heavenly product because it has all the best parts of everything. So you add the equity, but you don't add the number of shares. That's why you get this big inflated number. That's why you get the book value now at 7.53 for book value, because once you add in this 10 billion. Yeah, I'm sure I'm confused, but okay. Anyway, one last point. In terms of the rebound, the last 1 week we got this big rebound in all the airline hospitality stocks. So for Genting, it was out almost 10, but to reach the pre-pandemic, which is there's still about like 15% recovery before you hit. But the bigger moves will probably be on the hospitality. So all these stocks probably have a bigger upside. Our own view, Of course, if there's momentum, SIA will just spec out. But we think if you want to play up to the pre-pandemic level, so hospitality, Escort, and CDL will be the ones, and of course, Comfort. Okay, I'm sorry if I confused anybody, but let me just run through on RE&S, which had Province webinar with us. So they are an F&B operator. I think some of these brands, I think you can just say that they are specialized in the Ichiban brand because it's like sushi. This is 10 outlets, 13 outlets. So in the meeting, they are even bigger than Japan Foods in terms of outlets. But no, we went just to give you a flavor how are the F&B operators, the challenges of it. So the first thing they have is labor as a challenge. So what they want to focus now is on QSR. It's like McDonald's, fast, don't have to serve people, because what they want is a more sustainable business model, because they need it to be labor friendly, and they can hire part-timer and like fast food chains, where the work is less heavy. And it's also scalable because you don't need a chef like in a full service. Like you go Korea, you need a chef there. Okay. In terms of the delivery, it's roughly about 20% of sales, but delivery will remain important for them. Right now, delivery is as high as I think 2 million per month sometimes. So these are the main platforms they use in terms of order of importance is Grab, Foodpanda, and Deliveroo. And they use them because these companies have a huge marketing reach. You cannot compete. If RE&S suddenly decided to do delivery, they need to find a driver and then they have to pay a large delivery fee, because most of typically the bill is probably $50, $60. Unless your delivery bill, food bill is like seafood, 150, 200, then maybe it's worth for you to have your own independent. Otherwise, you have to rely on these operators. For them, delivery is going to be very important because to them they think it's a longer term change in behavior. And that's why delivery is going to be an important part of their strategy. In terms of rent, which is about 22% of revenue, they prefer fixed rent and not GTO. GTO means you can either pay fixed rent or as a percentage of your sales, because they are thinking of online too. Because if they do well, then the rental can come down, especially if they're going to do a lot more deliveries. So if it's on GTO, then the more deliveries they do, the more rental they have to pay. So it's not scalable. So they prefer a fixed rent. They plan to eight outlets. And the last point here is that central kitchen is important. So the big one for them is they're going to do ready-to-eat products. For us, ready-to-eat is basically, go to a supermarket or convenience store, you can get Japanese food. And it's almost a blue sky if they get it right. Because it's a totally new market and it's an open-ended, like how much can they sell? But right now it's less than 5. This is something that they are targeting. They still need to do some R&D in it and so forth. Okay, that is the end. I think we can go to questions.
I think I'll go first. I think I quite a number of technical questions, so just give me a moment. Yeah, I can't share my screen. I think I need to be made co-host to share the screen right now. Yeah.
Can you share the screen?
Let me see. Yes. Yes, I'm able. Yeah. Okay, so yeah, I managed to share my screen. So there are some of the counters that are listed out based on a question. So I'll answer only based on this the counters listed on my tabs. And then because there are times to be considered. All right, so looking at ESR, somebody asked, how's ESR doing? I would say that ESR today has a breakout of the falling wedge pattern. It looked great. But I just hope that this won't have a retracement back down, because if it does have a retracement, means that it confirms that this is actually island reversal kind of signal, and then when if it's a kind of like island reversal, it means that this may be a false breakout to the upside. Furthermore, you will look back on 3rd September. Price actually rejects 50 cents resistance zone. So furthermore, I think that that there is some sort of considerable correction. In any ways, if there is a correction, I think 0.420 to 0.435 will be the likely rebound zone going forward. All right. So looking at next one, ARA logos. ARA logos, I think there's like a double top. You can say that it's a triple top now. ADL is showing a slower down momentum. And then if this support at 0.870 is broken, then we will see further downside. You can see that Ichimoku is showing a thinning of Sego span A and B resistance Kumo. So hence, I would say that ARA is likely to go into a tremendous amount of period of correction going forward. All right, other than that, no further comments. Tencent, I think Tencent is range bound. Despite a break above I do a report on Tencent before, so you can go to Stocks BNB and read it further. But the false breakout at the major support and resistance with a hangman followed by a strong bearish candle down was well supported here. Upside, but I think there's some sort of struggling above at the neckline resistance at 489. So I think price likely is going to test out the major support and resistance zone at 493 to 517.4. So in this retrospect, right, if this doesn't break, then we will see another downside testing at a major support at 402 to 420 going forward in the longer run. Let's move on to the local banks. The local banks did relatively well, except for DBS. Which I will explain later why. I think OCBC and UOB, from the technical perspective, is look great, especially OCBC, which I returned a report last week. You may head over to stocksbnb.com. It talked about the fulfillment of the inverted head and shoulder. Broke out despite last Friday close with a bearish candle. Is not an dark cloud cover. Today, if it maintains that with a hammer light above the resistance, turn support at 1180, then we can see an upside testing to 1252 to 1276. Furthermore, I want you to focus on the larger pattern, which is this corrective descent channel, aka the flag, because you look at a weekly chart, it do resemble a flag. So this is going to break up. We are going to see $13 to $14 in the very long term. All right. UOB, yes, strong. Most likely this head and shoulder will be invalidated. You can see that the ascending triangle from the weekly chart perspective is going up, and then you can see that there are multiple resistance. These are area of resistance congesting over here. So likely this zone is likely to be weakened already. So hence I think that there's a stronger possibility of breaking up to the upside for UOB. While for DBS, not very sure about this, despite there's a smaller ascending triangle over here. Okay, but I think in order to clear, unlike OCBC and UOB, that's straightforward. You need to clear above $31 to be to confirm the upside. So I'm more apprehensive and a bit caution on DBS itself. Okay, so for Hong Kong, let's move on Hong Kong. Hong Kong Stock Exchange, pattern symmetrical triangle, but I think series of like range bound, lack of momentum. Even ADS showing an uptick, but price is not showing any strong momentum. So hence I'll take it as ranging. But what is comforting, you can know that there is like a smaller falling wedge. So in fact, there is like a candle over here, a bullish hammer, but the upside break is not very fantastic today. So I do not know, is it due to the 2 days last week? The market was closed for 2 days. One was due to typhoon, and another one was due to the public holiday in Hong Kong and China. Kunlun Energy, I foresee some upside based on price action, but trend remain on the downtrend. Strong impulse downtrend. Likely we're going to see 740 being rejected and then come down. I think another 3-wave down, and will be at $5.73 to $6.02 support zone. Yeah, over here, 1, 2, and there's a rebound thereafter. Moving to Singtel head and shoulder pattern. So any upside, like I said last week, it has come down. Although it's well supported, but price is likely, the rebound is likely to be capped over here at 22.92 to 24. And then if there's like a slow momentum or any bearish reversal, it kind of confirms the head and shoulder pattern, and it will just go down to, it will just break and retest 11.62 to 13.28 going forward. Lack of momentum for SMIC. Reason being there's a like a bearish descending triangle, weakened support, descending triangle support at 21.70 to 23.15. So hence, I think it will just drop to 16.75 to 17.75 in the near future for SMIC. Costco Shipholding. Last week, this bearish flag was confirmed, but it briefly touched at the support at 880 to 977. But this is like inside bar, but because of impulse downtrend after breaking off from the diamond, I think there is a possibility that it might go further to test 880 or 790 in the short term. So let's see. Price need to clear above $10.81 to be briefly safe. But even though if it clears above, then we are seeing that it's at $13.07 and $14 is likely to be a resistance zone, and then it will continue to sell off thereafter. Do take note that this is the first leg, and then if shall this zone that I mentioned earlier on rejects, and then there will be one more down leg to maybe $7.30. So hence we really need a lot of data to see. All right, for the Hong Kong counters, Hong Kong counters are likely to go into range range bound momentum going forward in the short term. Capitaland invest ever since it peaks and then rebounded at $3.50. It has tested twice. There's a panel going forward. So you take from a wave perspective, this is wave 1, this is wave 2. So we are seeing a possibility at one more downturn before rebounding. So in order for the rebound to happen, 3.46 need to be broken strongly, and then there will be a chance to break 3.54 and then continue on the third wave. So in retrospect, I think CLI Capitaland Invest is likely on the longer term, based on a wave theory, based on the initial wave, we are looking at a very strong bullish upside. For Capital Corp, last week, especially last Thursday, it broke all the major resistance, and then Friday it touches here. Today it closed, today it opened, and then initially at the first 20 hours it went up, attempting to break the upper resistance zone boundary at $5.56. However, if this is a shooting star, there will be a correction back to test the major resistance turn support at 5.48 before a rebound. All right. Overall, in the longer term, I think this is a symmetrical triangle. E wave has been confirmed. I written this article based on Q&A back in my Telegram channel. So if you're free, you can go there and check it out. I posted last Thursday. Yeah. So if there's a correction, we are seeing upside and breaks above $5.90 to $6 region. All right, last but not least, I think venture has been doing well. Falling wedge likely to confirm. So further confirmation will be if it breaks 19.33 to 19.54, and then next target resistance zone will be 20.72 to 21.14 in the longer term. All right. So that's all for me. I'll now pass my time back to my colleague, and then for the rest of Q&A. Thank you.
Jonathan, you want to go ahead?
Yeah, sure.
Your video.
Yeah. Give me a sec. So I'll take this first question on Netflix. Netflix current price is already priced in Squid Game. So for this, just because of how Netflix subscription works, it's difficult to price in just a one-off event. Unless you're saying that Squid Game, unless they can say that Squid Game, has brought in like X number of paid memberships, it'd be quite difficult to kind of price it in, because it's very different from, let's say, a movie where you can see the total revenues for that weekend. Yeah. So for the next question, how is your TP of $724 derived? Like I mentioned earlier, we use a DCF valuation formula with a weighted average cost of capital of 9% and terminal growth of 3%. How do you see the local telcos with cable evolve with Netflix? So this is quite interesting because when you look at, let's say, Singtel TV, their revenue is like less than 2% of their total revenues for the Singtel group. And definitely their revenues are getting eroded from video on demand like Disney Plus, Netflix, and all that. But the main advantage that they currently have, at least in Singapore, is that all these video on demand streaming services don't really, besides Amazon Prime, they don't really do live sports, which is, at least for right now, is an advantage that the telcos have, because they do generate a lot of your ad revenues from when they broadcast sports and all that kind of thing. So it's something that actually Netflix is trying to stay away from, because their policy is that they don't want any ads on their platforms. But definitely moving forward, you probably still see this the telcos with cable market share getting eroded over time. Okay, so the next one for Netflix. Why do you think the competition is only affecting short-term and not long-term? Can you give a short comparison of Netflix versus its most important competitor, maybe with Disney? So I think just now there may be some confusion. I mentioned that Netflix has a tough comps versus FY20, tough comparisons, just because the growth was so good last year. This year, definitely if you compare this year to last year, it won't be as good. But if you want to talk about competitor like Disney, there's actually kind of this mini war going on in India right now. So both Disney and Netflix are trying to capture the Indian market. But from an overall perspective, so Disney has half the subscribers that Netflix has. But in terms of ARM, which is pricing, their average pricing is about $4.20 something cents, which is like a third of what Netflix has right now. And also a lot of their subscribers, they had a big subscriber boost, and that was mainly because they launched Disney Hotstar, which is like their very low cost plans in India and other developing countries. So it kind of helped boost their numbers a little bit. So we still definitely see that Netflix is kind of ahead of the game for right now. I think the last question for me is, what's the competitive advantages Netflix has over Disney and Amazon Prime? And the biggest and most important competitive advantage. So the biggest advantage we actually see is that Netflix is the first mover. They're basically the first ones to actually bring large-scale video on demand streaming to the world. So this, they've already before Disney or Amazon Prime had acquired enough members, right? Netflix is already there, and also another point that they are kind of strengthening their moat by increasing the percentage of in-house production. So when Netflix first started, most of I think 80% of their content was produced by other companies like Disney and whoever. But that has kind of gone down a little bit. So right for FY20, 45% of the total content that they had was produced in-house by Netflix, and this has been trending upwards. So you see a little bit of reliance, less of a reliance on essentially your competitors, right? Like if you're starting to stream, content that is produced by Disney or HBO, now if you're producing more and more of your content, you can rely less on them and hopefully beat the competition. I think that's it for me for now. Yeah, thank you.
Natalie, you want to answer some?
Hi. Okay, I'll take some questions. I'll read them out first. Is CICT part of Capitaland Investments Limited? A second question would be, how sensitive is CLI to interest rate hikes? I think I saw a similar question. Is the debt level of CLI considered high for this type of business? I'll take these two questions first. Okay, so for Capitaland Integrated Commercial Trust, it is an associate of Capitaland. It carries the same name. However, in the past, when it was still Capitaland Limited, they used to consolidate CICT. But with this demerger, as well as the DIS, distribution in specie, where some of you unit holders actually receive a portion of CICT shares as part of the purchase consideration. So with this demerger and DIS, the amount of shares that CLI actually owns of CICT has decreased to about 22.9% to be specific, and therefore now they no longer consolidate CICT. So CICT does contribute to CLI in terms of dividends. Yeah. Just for those of you who are curious, CLI still consolidates ART as well as CLMT, which is the Capitaland Malaysian Trust listed in Malaysia. Okay. The second question was the two remaining questions are related to interest rates and the debt. So for CLI, the amount of debt that they have that is hedged is about 63% on hedge basis. So meaning to say, if let's say the interest rates were to move, 63% of the debt will not be affected by a change in interest rate. I think that is still relatively looking at the market. That is still relatively in line with what their peers are doing. Second question is, sorry, I just also want to point out that for the REITs the stake of the REITs that they do have, or rather the REITs that they are managing, most of them have very high interest rate hedges, above 80%, some even 90%. Yeah. Okay. The second question was about the debt ratio, or rather the debt level for CLI. Is it considered high for this type of business? So for CLIs, when we look at the debt ratio, it is about 60% or 0.6 times. And when compared to the kind of comparable peers, if you look at my report, comparable peers for CLI include that Blackstone, Brookfield, Cohen and Steers, Charter Hall, Goodman, Lendlease, and ESR. Their debt to equity ranges about 8.5 to about 122 times. And really, this really also depends on the amount of sort of real estate investments that they hold on their books, which is the IP, the actual assets. Yeah. So of course, if as I mentioned earlier, CLI is still relatively asset heavy, and if they were to take, acquire these kind of assets, they will definitely need to employ a bit of leverage. Yeah. So the short answer to this would be, it really depends on the breakdown or the allocation between the fee income as well as the real estate investment. Okay, let me just scroll down to see if there's another question regarding CLI. Recently, CLI invested in its share buyback. What is your take on the buyback, even though it is only newly listed? So actually, for the share buybacks, it doesn't really change the metrics much. It's another way of sort of returning capital to shareholders. When the number of units decrease, of course, it means that future dividend or EPS, it will be slightly inflated because the number of shares have decreased. That is on one front. If you look at finance theory, this is supposed to be a signal to the market as well, that it means that the company thinks that the shares are undervalued. Yeah, but overall, I think it could just be a prudent capital management for Capitaland. They do have quite a few opportunities for investments. I think, as I mentioned earlier, they are trying to expand their exposure to the real estate, to the new economy sectors, as well as to the family, multifamily, and the PBSA kind of accommodation type. So they do have investment opportunities, but in the meantime, it could just be a way for them to employ their capital better, because as we know, Capitaland is able to tap both bank borrowings as well as the debt markets, and they have always been able to get very tight spread to the current interest rate bonds, etc. Yeah. Okay. So I think not much concern about this this share buyback. About 2 million, if I'm not wrong, last week. Okay, I'll take another question about okay, there's a question about the acquisition, the merger of ESR REIT as well as ARE Logos. So I would like to take that question first. I think overall, the deal does look quite compelling because, first of all, ARE Logos, this is a bit of a backstory. ARE Logos, 100% exposure to logistics properties, which, as we know, logistics, the demand for logistic assets is on the rise due to higher e-commerce penetration, which is expected to here to stay for the most part. And for ESR, they have a 47% exposure to logistic and high specs kind of assets. So overall, this acquisition, this merger would first of all increase the AUM to about $5.4 billion, making it one of the top 10 largest S-REITs. Yeah. And I think the more compelling story would be that the pipeline that ESR and ARE Logos will have access to because of the merger of ESR and ARE, their sponsor companies or sponsor, yeah. So the amount of assets that they have exposure to is actually like almost they are the largest real estate operator. Especially in the new economy kind of asset class. So the pipeline of assets that they will have access to is quite great. Currently for ESR, they do have some private funds as well as a Korean REIT, but this ESR ALOG REIT is expected to be the so-called flagship REIT, to quote the management. Yeah. And they're quite established, so the amount of executable pipeline for currently for ESR would be about 2 billion, so that they can start to slowly try to tap this pipeline. So overall, still quite positive. But I think the market has sort of moved in advance, and they've sort of anticipated this deal. So I think after this announcement, the share price did come down slightly. Yeah. Okay. I see a question about Capital DC. Let me read the related article first. I'll pass the time back to the rest of my colleagues for now.
Yep, thanks. Let me just try to answer some questions here. Please comment on ClearBridge. Thank you. So for ClearBridge, we dropped coverage. It used to be under our paid research. The latest for them, I guess one of the drivers would be they made an announcement. I think just on Friday, I believe, that they're going to make some investments overseas that are EBITDA positive. So that is the latest development. I guess the other things to watch for would be if their ART test, Biolytics ART test gets approved. So that's in Singapore. So that's one. The two main ones would be the recovery in their Indonesian operations, which was hit during the pandemic. When they had the disruption because everyone couldn't, the hospitals were closed and everyone couldn't come out. So it was the dialysis, kidney dialysis. They run those centers. So that is one of the businesses they run, which can generate a lot of recurring income. I'm just trying to run through the other one. They also have a Philippine center, which was also affected by the pandemic, by the impact of pandemic. Apart from that, we don't really, ever since we dropped coverage, we didn't really follow much. But I think this will be the latest developments. Yeah. So yeah. Sorry, don't have any like really to accept the offer for Sembcorp Marine shares. What happened if we didn't accept the offer? The answer isn't very clear cut. Obviously, the offer is 8 cents, and then now I think 8.1 or maybe 8.2. If you don't accept the offer, I mean, you worry there could be some sell down, but the downside is if you don't accept this offer, then maybe there could be a sell down below 8 cents. But possibly that is unlikely right now, I guess, because if whoever want to do it, they really should have been like tendering their offer right now. The second downside risk, I think, should be maybe once they go ahead with the merger with Capital, whether will they raise any more equity. So that could be one other risk. Again, it's unclear right now. But of course, the upside is that that there's going to be a rebound in oil prices. So for me, I mean, my own view is if you're giving up now, you're probably just giving up 0.1 cent in terms of downside risk, but the upside, if oil prices continue to rally, maybe the share price being held back by this tender offer, otherwise it could rally along with oil prices. Yeah. It's not so clear, but the risk reward kind of favor maybe not to take the offer for now. Yeah, my own view. I mean, sorry, because it's debatable. It's not very clear cut answer. Let me just run through. I've shown some really poor media write-ups about Aztech Global, how they destroy shareholder value by taking the company private. How should buyers of Aztech be cautious about management with respect to their past practice? To be fair, I mean, if you go through the prospectus, the time when they again, we don't want to be too naive about it too, but if you go through the prospectus and you look at the timelines, when they got the big customer, their major customer, and the time where they actually prioritized, make the decision, there's almost like I think, if I'm not mistaken, almost a 1 year gap. And at that time when they got this big customer, it was just an up and coming emerging technology that I think the company just made a bet on. Yeah, and of course it really became a huge hit. Again, if you just look purely at the timeline, they didn't privatize it when they secured this customer. So they might have to give a bit of benefit of the doubt there. Yeah, it's not like they got this big customer, then they privatized. Then of course, then it's a bit more curious why then they privatized when they knew there's going to be this big jump in earnings. But at that point in time, this particular customer, which was the up and coming technology, they were very strong in semiconductor chips for power management. That's why all the video cams that they use doesn't really need a connection to power, just use AA battery at the time. So that was their strength. But again, my guess is they probably took a bet. Again, that's just my own view. With Fed starting to taper next month, will you be seeing a downturn in equities market as yield rise? I don't think so. I think these days is a bit different. This so-called taper tantrum may not be so obvious because the Fed officials are almost talking to the media almost every day. I think if you turn on Bloomberg or CNBC every other day, there's probably one Fed official talking about the market, about tapering. So I think this is quite well flagged out, and we still think interest rate will rise, but I think the base case, it will just rise in a gradual manner. Yeah, I don't think there will be a shock to the market if next month they announce they will taper and start doing it the following month, December. I think more or less well flagged out by the whole market. Yeah. These days, communication by the Fed is, I don't know, almost daily. There's someone talking from some Fed official will be on the media. So I don't think that will be the huge shock as in the past. Glenn, I'm not sure you want to talk about the analysis on SGX.
Yeah, thanks, Paul. I think as Paul mentioned earlier about the MSCI China A50 futures. So yeah, those could actually could divert the trading volume away from the SGX's FTSE A50, as we can see that the FTSE A50 futures account for more than 50% of the total equity index futures traded. And even though SGX does not provide a revenue for its China A50 contract, we estimate that it contributed about 20% to its overall derivatives revenue and about 10% to its overall revenue in FY21. However, I think recently SGX released their monthly statistics for their market turnover. So it's quite positive. You can see that it has risen for September. It has risen 11% year on year to 27 billion, and which is the highest in 4 months. While the SDAV, the securities daily average value, was also up 11% year on year to about 1.2 billion. Yeah, and give me one. Okay, so I think we can see that while this could actually potentially the new MSCI contracts, the futures contract could actually pull it away, but it's quite positive, and we can only, as Paul mentioned earlier, we can also only just wait and see. I think that's all my analysis for SGX.
Thanks for that, Glenn. Let me just move on to this question before I hand it back to Natalie. Why is there so much emphasis on reopening when Singapore still has work from home and dining restrictions? VTLs will only contribute slightly to the economy due to limited countries and quota. Will this reopening really contribute a lot to local economy, or is it driven by sentiment? I think when you play on the reopening, it's about the direction. I think when they really open up everything, then the share price will probably be correct by then. But just to give you some numbers, not tourism. If you look at the latest number, is I think tourism about 28 billion Sing dollar a year, and our economy 500 plus. So tourism is 5 percentage points of the economy, and our country goes only 2-3%. So that 5 percentage points is a lot of impact when this thing suddenly disappears. So when it turns on, I mean, on paper, you get an incremental 5 percentage points of GDP growth, which I think is a bit understated because these are tourism receipts. These are not like the secondary impact, how it stimulates indirectly other parts of the economy. So it is huge. Again, just to give you a simple, I think we all know about hotels. Just telcos alone, mobile operators like we mentioned before, roaming is 20% of revenue. I think profits could be almost 1/3. I mean, they don't really disclose because the margins are so high. So it is a very significant. Although I agree with you, the VTS, the most important countries is China, Indonesia, and India in terms of contributions to tourism receipts. Of course, Malaysia. Malaysia, there's a lot of foreign workers. But these are the 3 main countries, and none of the VTLs actually hit these countries. But again, everyone is playing on direction. By the time they open up to everything, the market, all the airline stuff probably already corrected. So people are just, as usual, the market is looking forward and just taking, making the directional bet that all these major countries will eventually reopen. Yeah, I hope that answers. I'll do one last time before I hand it over to you, Natalie. In view of the MAS move to tighten monetary policy, what's your view on trading foreign exchange, Hong Kong and US shares? it basically just says that there's a tailwind to the Sing dollar compared to the US dollar, but I don't think investors are going to take that maybe 1 to 2% improvement in exchange rate when they actually decide to buy. It probably helpful if you're buying it might be more impactful, I mean, if you're buying a US REIT here, but I think if you're buying US shares, I don't think 1 to 2% move over 1 year is going to make a difference for a lot of investors in US and Hong Kong and US shares. When most people probably just keep a share for 1 month or maybe even 3 days. They're not even 1 year. Yeah, I hope that helps. Thanks, Natalie. You have any?
Hi. Okay. I found another question on ESR and ERA logos combination. So the question is, ESR only offered to ERA logos as 9.5 cents cash as well as 1.67 ESR shares. Is it too low and how do you object? Of course, for the second part of the question, they will be holding EGM for this merger. So as a shareholder of either ESR or ERA logos, you can actually vote. The threshold for the approval of this merger for ERA logos is higher because special extraordinary kind of voting is required to amend the trust scheme for ERA logos. 75% of the unit holders must vote in favor. So if you are strongly not in favor, then that's how you can do it. Okay, so for as to the valuation point of view, ERA logos being a pure play logistics operator, they have actually done quite well, especially post-COVID, or rather like since we are recovering from COVID because of the e-commerce trends. They also have quite substantial cold storage facilities, which of course is useful and helpful for the vaccination as well as supermarkets, etc. With regard to the share price, if you compare ERA logos to its peer, which we will look at Mapletree Logistics. Mapletree Logistics actually trades at a price to NAV of about 1.6 times, and also do note that Mapletree Logistics has a market share of about 8.9 billion Singapore dollars, and this represents about 8.3% of the REIT market cap. Compared to ERA logos, market cap of about $1.3 billion, and that represents about 0.9% of the Singapore REIT market cap. And they're trading at a 1.4 times, yes, 1.4 times price to book. So, frequently we hear, in the past 3 mergers that have come, that happened in 2019, one of the benefits that the management like to quote is scale, larger, blah, 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 after the merger, the result in a larger scale, better cost of funding, etc., which I think that there's some truth to it. As a larger vehicle, Mapletree Logistics does command a premium compared to ERA logos. And in this case, we see that the premium is about 0.2 times price to NAV. So as I mentioned earlier, 1.6 versus 1.4, Maple Log versus ERA price to book. So I think that it is only fair that ERA logos does trade at a slightly lower price to book, a discount to Mapletree Logistics, number one. Number two, for some of the investors who are actually holding ELOG, and if you look at the cash consideration, some of you may actually notice that the price that they are tagging to the ESR share is 0.53 cents, and that is actually a pre-COVID price, meaning that ESR share price is currently around the 40 plus cents region. So it's actually they're actually tagging ESR shares at a 6% discount, or rather ERA logos investors are supposed to accept this ESR share at a 6% discount compared to pre-pandemic prices. And I think this is one of the questions that was raised to the management when we had the briefing. But I think overall the management's comments was that what we are looking at right now is a vehicle that has a larger pipeline, 50 billion worth of new economy assets, 2 billion which is immediately executionable, And I think the scale, the cost, the benefits of actually a reduced cost of capital, I think the management actually did say that the cost of capital is expected to drop from for ESR perspective about 3.2% to about 2.2%. So there's actually significant cost savings from this expected from this larger entity. So I think you have to view all of these things in consideration. Not to mention because the merger probably also came about because of the merger from their sponsors, the ESR Cayman as well as ERA Asset Management, and likely due to overlapping mandates, which might result in conflict of interest, hence, giving rise to this merger, which actually, if you look at the merits of the merger, the larger scale, the pipeline, these are all positives for both the incoming merging entities. Yeah. So of course, we are of the opinion that actually the potential benefits of the merger are actually quite compelling. Yeah. So it might seem like the valuation might not be to your expectation, but I mean there is of course long-term benefits to it beyond the short term. Okay. Another question about Capitaland investment. How will CLI compare to the new ESR, which will acquire ERA and is bigger than CLI? So it is true that the competition for amongst the real estate players is intensifying. Of course, ERA will be a formidable adversary compared to, and they will compete for capital, etc. Also, of course, not to mention ERA is already quite has a significant portfolio in the new economy kind of assets, which Capitaland is still trying to grow its presence in or grow its exposure to. So definitely there will be some competition for the same kind of private capital investors. And I think for Capitaland, they are strong in China, they're strong in Singapore. They also have presence in Japan. They are progressing with their Korean data center fund. They have a strong presence in India due to the acquisition of Ascender Singbridge. So I think in terms of real estate, it's a very big market, and there's still a lot of there's room for competition, be it different asset classes, different geographies, but not discounting the fact that ESR will be a competition to Capitaland. And how will Capitaland compare to ESR? I think for the Capitaland will have to rely on their own expertise as asset managers, as well as the new added capabilities of fund management, which is I previously mentioned there are 2 senior hires that will be focusing predominantly on the private equity space, and so of course growing the private REITs under their management, private entities or private funds under their management. Okay. Sorry, the question on Capital DC. For Capital DC, the question is referring to Capital DC, the ChartWiz email. Their long-term bearish TP is about 1.6 to 1.7. How many months is long-term? Okay, so I cannot speak on behalf of ChartWiz. However, this looks like it is a technical analysis kind of target price. I think in earlier sessions, we mentioned that Capital DC seems to be having a bearish or a downtrend. I'll see whether Wiren would like to take up this part of the question. And comparing this $1.60 to $1.75 target price versus Phillip's target price of $3.20, why the difference? I've mentioned this a few times. First of all, our target price actually factors in assumed acquisition of about 500 million slated to come in the fourth quarter of 2021. Capital DC is very interested in growing inorganically through acquisitions, and so because they have already sort of optimized their portfolio and done whatever AEIs that they could have possibly done to make the assets more efficient and bring in more revenue. So the only other way for them to grow would be through acquisitions. So hence we have forecasted in 500 million worth of acquisitions for Capital DC. That is one of the reasons behind our target price also. because our target price uses a DDM kind of valuation method. Yeah. Second of all, we are looking at it from a fundamental point of view versus the target price, versus technical analyst view. So it's a technical versus fundamental analysis kind of comparison here. So fundamentally, we see that Capital DC, given that the data center moratorium still has not been lifted yet, although there are talks of it being lifted in the later part of 2021. For now, and even if it does get lifted, there will be about a 2 to 3 years kind of developmental phase where for the construction development of these data centers in Singapore, if the moratorium is lifted. Regardless, because of the shorter WALEs that the assets in Singapore have, most of them are actually coming due up for expiry within the next one to 2 years. So by then, we still expect that Capital DC will still be able to reap some positive rental reversions from these assets, given the sticky nature of the tenants, data center tenants. Yeah. Overall, also mentioned that earlier in the year, Capital DC is also sort of expanding its footprint into China, and they acquired an asset, and also of course the relationship built with the seller of the data center asset in China will provide them a pipeline, so that is also a potential positive for them. In terms of why the TP, the share price, a possible reason why the share price could be depressed, a speculation here, it could be because of the potential listing of Digital Realty's portfolio of data centers. Yeah, so that could be one of the reasons why the share price could be a bit depressed presently. I think that Wei Ren would like to address the TA for Capital DC. I'll hand it over to him.
All right, thank you, Natalie. So yeah, I think just now I missed out a point while typing out the Capital DC why on the future development. Although last week it did have a slight bullish rebound, but you can notice that the three white soldier is not very kind of like a strong full body, and then price actually has a correction. And then after that, there is like a Ichimoku actually shows that last Friday it did not clear above the larger Kijun Sen, and today it just shows a bearish candle. All right, so in this retrospect, I maintain my view on this. All right, is that $2.22 to $2.28 remain my major rebound. Okay, you can see that this resistance zone at 2.44 to 2.48. Still very strong, so hence I think what Natalie says about the target price, I think is still valid. It's just that where are we looking at? So I remember her target price is 320, if I remember correctly. Okay, correct me if I'm wrong. But if we buy, if we have we spot a potential reversal over here, there's so much room to $3.20, and you can look at the larger weekly chart, right? It's still on the upside. All right, so $3.20 should be somewhere around here. Okay, so and that is only the initial part. Why are we going through quite a long kind of like a correction? Because based on wave theory, we have finished a wave 5 terminal. So right now we are ABC kind of wave right now for Capital DC REIT. All right, so that's all. Is there anything else, Paul, on your side before we close off?
Yeah, I think we are fine. So thank you everyone for joining us. Thank you so much for all your questions. I know there are still some that we may not be able to answer, especially those on Hong Kong, China. It's better to either ask our Hong Kong team or maybe our global market dealers, because these are we are mainly on Singapore and US. So thanks everyone. So hope to see you maybe in some of our webinars tomorrow or on Thursday, or maybe next week. So thank you everyone. Have a good week and take care everybody. Bye bye.